Welcome back. George Joseph from ASK Investment Managers joins us now to talk more on the markets and the road ahead. George, good morning. Thank you for joining in. With the earnings season now coming to an end, where does the next trigger for the market lie? Because the policy is out of the way, earnings are out of the way. What does the market now look forward to for its next leg of up move, if there is a potential for that, that is?
Yeah, so if you look at it, the bond yields have been significantly lower, and that itself means that the equity valuations can inch up. If you look at the way the GDP growth has been very strong, the falling inflation, reduction of monetary policy rates, and also the improvement in the liquidity of the banking system, and the requirement for the central government to borrow in the market also has reduced. All put together, the bond yields have corrected significantly, which is very good from a valuation point of view. So if you look at from Nifty earnings perspective, I was just looking at the 47 odd companies which has reported in earnings. It has been fairly decent and probably better than the estimates. So almost 8-9% EBITDA growth as well as 9%, 8-9% PAT growth. So which is very interesting. So from a Nifty valuation perspective, we are very constructive, and we see there is a good amount of cushion in terms of the return potential in the next 2 to 3 years.
Okay, so that's the return potential for Nifty. George, I wanted to understand what's your sectoral bet now? Are there any sectors which are fairly valued? Because that's not something that we are seeing in the markets overall. So any specific theme that you think would work from here on? Because most of the export-oriented companies, they've spoken about what threat they would see if the US tariffs do continue the way it was announced earlier. Do you think domestic themes would work better?
Definitely. If you look at our market commentary, which we have published for the last 2 months, consistently we have been saying that we want to focus more on domestic-oriented businesses. That's where we see the leg up in terms of earnings growth as well as valuation comfort. So it's a decadal shift in the business cycle, which started in 2020, post-COVID. And we see that continuing in the next 3 to 4 years. So domestic-oriented businesses like cement, private banks, which has not worked in the last 5 years, we are quite constructive at this point in time, and that's where the valuation comfort is there, and probably what we are expecting in terms of earnings growth revision in the second half, as well as the GDP growth rebound and the rural economy also picking up. All put together, there is a good leg up in these domestic sectors visible. So export-oriented sectors, we are quite benign in terms of the visibility, and also we are quite light on that.
But domestic-oriented sectors are huge, right? There are so many to choose from. So tell us a little bit more. What are the stocks or themes that you like?
Yeah, stocks, it's difficult to discuss, but at the same time, the themes, what we like is the manufacturing theme, which we have been bullish on. And also, if you look at the infrastructure, capital goods sectors, so all the domestic-oriented sectors, specifically, I believe the valuation comfort is mostly in the private banks. Structurally good companies, balance sheets have been fantastic, and also they have been going through various, integration and various other issues, because of which the stocks have not performed. And the big recoveries which we have seen in the PSU banks, probably that is the fag end, and we will see more of the private banks getting re-rated in the coming years.
George, is wires and cable space a part of your domestic themes because of the fact that, of course, there is increasing competition, yes, but most of these incumbents have managed to withstand that, barring that initial knee-jerk reaction that we saw. Does that feature as part of your bullish themes as well, or are elevated valuations a concern?
Yeah, so we have been constructive all along, but the valuations is a concern at this point in time, and we are looking to carefully evaluate these businesses. from the case-to-case basis, and also the merit in terms of the exposure towards US and so on and so forth. So we are not as constructive as we used to be earlier, but at the same time, obviously, as you rightly mentioned, the growth is quite strong in this space. So we are not as bullish as we were earlier.
Okay, what about specialty chemicals or agrochemicals, George? We've been getting very mixed commentary. Some of them said that this is the start of some recovery phase. Today, Deepak Nitrite said that maybe pricing pressure is not over. What's your take on some of these names?
We like some of these stocks, especially from the specialty chemical space. If you look at, it's a very diverse set of companies available in that. We need to do a lot of bottom-up research to arrive at that. We have a strong team in place who does these research very diligently, and that is where we think we can make a differentiation. So, looking at the space, in particular, specialty chemicals, we are more constructive there because most of these companies are coming out of a big lull period in 2024, and 2025 onwards, we are seeing there is a good green shoot developing, and in terms of the valuation comfort also is there. So many names in this space has been beaten down to dust post the big rally which we saw between 2022 to 24. Therefore, we are constructive there. So if you look at from pharma, generic pharma perspective, as well as specialty chemicals, we are more bullish on the specialty chemicals relative to generic pharma, which is more exposed to US.
Thank you very much, George, for joining in. Need to get into a break. On the other side, we'll talk about autos.